Just today I have Michael on the phone, and Michael's from Bethlehem, PA. That's correct, Michael?
That is, yep.
And we're in Pittsburgh. So Michael's essentially an out-of-state investor, out of the area investor. He's in state, but he's kind of far. Bethlehem is what, as far as distance wise?
Like 4.5 to 5 hours, depending on traffic.
That's kind of far. I mean, I don't invest out of state. I don't have anything. I'm born and raised in Pittsburgh, and everything I own is here. So yeah, I'm a little gun shy about that because I don't have the team. I haven't put the time together to put a team together, and so it's a challenge. And I'm glad we had this call because you had a lot of really good questions. You had emailed me like 5 really good questions. I thought these are all going to be good because I get these asked all the time. So, do you own other properties? Is this the only one?
The property that we're looking to purchase would be the first investment property. We own our primary, but be our first investment.
So you own your own home, and what kind of got you interested in just investment property? Just what's the thing that fueled that fire?
So when COVID hit in our last property, we came into a bunch of equity, and I started kind of seeing different forums on how we can use that and put that money to work. I've been investing in stock market and just other types of investment vehicles, but had never gotten into real estate before. So our first plan was to do a home equity line of credit and use that to buy our first investment property. And while we were in our search, my wife became pregnant with our second child.
Okay.
And it made the need to go from our current starter home to a new primary. So we flipped our search. So we ended up buying a primary while still owning our previous home. I was someone that wanted to rent it. My wife wanted to sell it. It was a good seller's market, so we ended up pursuing that route. But now we have that capital that I want to put to work, and we're starting to kick the tires on investment properties again.
Fantastic. Okay, and you guys are both on the same page, that's helpful. I know when I first started, my wife and I, we were diametrically opposed. We weren't on the same page, and I thought that was a way out and a way for a future, financial freedom for myself. So she's glad we did it now, but it was, it's nice that you guys are both on the same page.
Yep. Yeah. I mean, we both have very good jobs, but what we both realize is that we're trading time for money.
Yeah.
So it'd be nice that, where we don't have that time to trade, that there's still other ways that we can bring in some income.
Absolutely. Okay. So one of your questions was, and I get this a lot, this is probably number one or two. What neighborhoods in Pittsburgh are you currently investing in and why? And then you have a sub 1A is what neighborhoods do you avoid as a property manager and or investor? 2 awesome questions. I'll buy properties, I don't know who made up this A, B, C, D category, but that's what I use all the time. So an A category, for anybody who doesn't know, is like a high average income neighborhood, a high household average income neighborhood, good school districts, highly desirable, low crime. That's typically an A neighborhood. Sometimes an A neighborhood might not be the best school district because it might be an area like what's called Shady Side, that's the city of Pittsburgh. So city's not the best school district, but Shady Side, if you live over there, a lot of times your kids are going to private schools and stuff. So that's typically an A neighborhood, and a D neighborhood would be like a very low average household income, high crime, just dilapidated houses, and there's potential there. Like those areas could be the next hotspot. You hedge your bets on gentrification happening in those areas. You hedge your bets on you're buying at rock bottom. It's only up from there, but that is really, when I say bets, those are bets. Those are gambling because nobody knows what the next spot's going to be. I'm telling you, I've been in this a long time, and some people get lucky. You just don't know. You can hedge your bets. Okay. So if you're out of state, I would focus more on A, B, and C areas. Now, unfortunately for you, A areas are like, and for myself, they're almost untouchable. You're just not making enough there's so much demand, and you have a family now, right?
Yep.
You want a good neighborhood. So you and I, the investor, we put our investor hat on now. We're looking for properties, and owner occupants are looking for the same properties. So now you're going against an owner occupant, you're never going to win that battle. They're always going to be able to pay more for that house than you can. So the A areas are almost untouchable, and anything in an A area just will probably end up losing money short term, and it might actually make you money long term. But I know you're in this to positive cash flow and make money long term. Okay.
Yep.
So the B and C areas, even like a D plus area. So I will invest in all of those areas. I'll invest in a really bad area sometimes, but the price has to be so appealing that I can't walk away from it. It has to be so appealing, and I'll typically buy them and then I'll sell them right away, because I don't want a long-term buy and hold unless I foresee some economic changes coming down the road, unless I'm going to hedge my bets. Like, for example, if I bought, I own a home that recently we paid about $40,000 for it. Good, clean home, D plus neighborhood, rented out for $700 a month. We got the rents up to $800 a month. That's not a bad little cash flow. It's not a bad first start for somebody. But is that area going to increase in value? I don't think so. I probably don't want to hold that property. Our goal is to probably get rid of it and sell it and make a few dollars and, move on. Okay. So where do I buy? I buy in any area. It just, my strategy changes. So that strategy I just shared with you, I don't want to own that home for more than a couple of years, then I'm going to sell it. We recently bought 2 duplexes in a B neighborhood, very strong B neighborhood. And I bought it with 2 other partners. My one partner came up with all the money and we found the deal. So we brought 2 things together. He had the cash, I found the deal. We put a nice little portfolio together, 2 duplexes right next to each other, deeded separately. And we probably lose, the first couple of years, we'll probably lose $300 a month, just because the person we bought it from, they'd owned it a long time. They didn't raise their rents. They didn't do a lot of repairs. So, we had to go in and raise the rents so we could at least somewhat close to covering our mortgage. Then as the tenant moved out, we had to put 5 or 10 grand into that unit. We got another tenant just moving out now. We're gonna have to put 5 or 10 into that unit. So the first 3 or 4 years, that whole incubation process it costs money. It costs money to get those up and running. But 3 or 4 or 5 years later, those properties are worth 10, 20, 30% more than what they were when we bought them, for 2 reasons: appreciation, forced appreciation because we put some repairs into it, and the increased rental income. So we were able to buy something that's a loser for 2 or 3 or 4 years, but then it will be a winner. And sometimes that's the only way to get something like in an A or B or a C plus neighborhood. You got to be willing to kind of take a step back in order to move forward, because the demand is so great.
So in that scenario, are you using your money or your investors' money, or are you going to any lenders in that scenario as well?
In that specific scenario, what we did, he's a friend of mine, and he was a client through Mace, our property management company. He was a client, and then he became, we became partners. I really like the guy. I would borrow money from him. He had excess cash. He's like, you know what? I don't see any good investments. How about if I lend money to you? So to answer that question, in this specific case, he was my lender. He was our lender and my partner. So he had 2 hats, right? He was the lender. So he put his lender hat on. We prepared a note and mortgage. We pay him every month for a portion of the note and mortgage. And now he puts on his investor hat, and him and I own it along with another partner. So
Okay.
it's quasi, he's a lender and a partner. And then what we did was we refinanced it. We got a first mortgage of, let's just say $200,000, and he holds a second mortgage of 20. So it was great because I got in with zero money down. He got in with a little bit of money, a lot up front, but then he got most of it back when we refinanced it. But in most cases, we're borrowing money from him. So he would have his lender hat on. I would say, hey, Chris, can I borrow 200,000 to buy this duplex? In 6 months, I'm either going to sell it or refinance it, and then I will pay you back and pay you 8, 10, 12, 15% interest. So that's how we do most deals, is we get private funding, just like they teach you on Bigger Pockets and on the internet. We get private funding, we use other people's money, and then we refinance it or we sell it. And we try to get all of our money back out. So in a perfect world, I bought one a few years ago, and it was a 4-unit duplex and a duplex. We bought them all, we refinanced them, and 6 months after our purchase, we were able to pull out $40,000, which is a beautiful thing, because just imagine you bought these with zero money down, you used someone else's money. At the closing, 6 months later, you got the properties performing better, you got the rents up, and we were able to pull out $40,000 and put it in our pocket tax-free.
Did you do any rehab to increase the value of the property, or
we did a little bit. We did a little bit, and we got the rents up. The rents were really low. So a lot of times we'll look for underperforming properties. That's just like, I guess, you look for underperforming stock, and you know, and we see the value that other people don't see. And sometimes I have a hard time in convincing clients, you know, like yourself, because I'd say to you, look, Mike, we're going to be able to get these rents up. You're going to have a couple bad years, you know, but sometimes that's where the gold nuggets are. That's where the good deals are sometimes.
Okay.
Yeah. So question number one, just so we go through it, what neighborhoods are you currently investing in? Really, what changes is my exit strategy. You know, how long I want to hold on to it. So that's what changes. Okay.
Okay. So you mentioned A, B, C, and D neighborhoods. I guess as an out of area investor, you know the market very well, and you can probably just look at a map and tell what area is which. But you know, what tools would I use to be able to identify that?
Even, you know, what's nice about the internet now is you have the Google Street View. You have things like that. It's like all day I must have looked at, honest to goodness, 25 properties today, because I get the leads come in and then I have to look at them. But you don't have to leave the comfort of your own home. It's kind of nice.
Yep.
But there's only so much you can get from a Google Street View, but that's a super helpful tool. So get really good at using that. Get really good at using, in this case, we're in a county called Allegheny County. That's where all of Pittsburgh is, and that's where most of the surrounding urban areas are, in Allegheny County. So you want to get real good with using the Allegheny County assessment website. All right, can you see that?
Yep.
All right, so it's the Allegheny County property assessment website, and you'll go to this page. It's the search page. And so, for example, let's just pop in an address here. I'll just pop in one that I bought about 9 years ago. That's probably been longer than that. The 1112 Fredonia Street. So it says here's the owner, AIH LLC. It looks like I bought it in 2015, 7 years ago. Right down here's the assessed value. It's 13,800. Why is that important? That's important because that's how the county assesses my taxes. So according to the county, my property's worth a lot less than it's worth. It's probably worth about $110,000. Fortunately for me, I paid $15,000 for it in 2015. Therefore, the county is assessing me at such a low number. Now, that can change. And why is that number so important? Because if you purchase it in today's market, you're going to pay, let's say, $100,000. Then you're going to potentially get reassessed at a new sale price. And your taxes could go from, let's just say, $500 a year to $1,500 a year, or possibly even $2,000. I think they cap it. I don't think they can. I think there's a cap on how high they can assess you the first time, but I could be wrong on that. But what that does is, let's say your cash flow in this property, and you don't know how to use this tool and you don't understand it, then you can ask me and I can help you. But what you need to understand is the basic premise. You need to look at this current assessed value and think, okay, if I get reassessed, my cash flow is $300. That reassessment kicks in, my taxes go up for the county, for the school, and for the local, and my cash flow just went from $200 or $300 a month to zero or minus or $50. So the average investor doesn't look at that. They don't know that. Their real estate agents don't tell them that, because their agents either don't know or they don't want to screw up the deal and lose the deal. But that happens to me. I probably bought 15 properties last year, and depending on where they're located, now this is in the city of Pittsburgh. The city of Pittsburgh has typically not been reassessing, but I bought properties in Brentwood, which is Brentwood School District. I bought properties in Crafton, which is Carlington School District, and some other properties. As soon as I purchased, 2, 3, 4 months later, I got reassessed and my taxes went up. But I was expecting that.
Okay.
It's okay to expect it. It's a lot different than not expecting it. So this is real important to use this, because you look at things like that. You can also look at the owner history. I look at that just to see, okay, who owned it before? Was it an estate? Did they inherit it? Just things like that sometimes aren't that important. This is a real important tab. It's called the tax info tab. So you scroll down and you see if this person pays their taxes. I was sweating it there. I wanted to make sure I paid my taxes. Now, if I didn't pay my taxes, these would be yellow. And it only goes back 4 years. And this is only the county tax. So if I see the owner hasn't paid taxes for 2 or 3 years, I'm kind of excited, because they have to be somewhat motivated. Does that make sense?
Yep. So that's how you're kind of finding. Are you looking at this for like off market deals too?
No, even anything I buy, the first thing I do is I go to the county it's in, and I look at the Allegheny County website in this case, because that's where 95% of the properties I buy. And I see, do these folks pay their taxes? That's going to dictate maybe how motivated they are. Maybe not.
Okay.
But that's important to know. And then you can get a good look at the house, because sometimes when you do a Google Street View, it's hard to see the address. You don't really know what the house looks like. So this is what the house looks like. Now, it doesn't look like that anymore, and I'll show you what it looks like. We'll do a Google Street View. I'll share that with you. Maybe we'll do that now.
Okay.
Can you
That's
see?
great.
Oh, did that pop up for you?
Yeah, it did.
Oh, very cool. Okay, I wasn't sure if I'd have to. Yeah, so this is the house here.
Okay.
So let me switch over and see if does it go back?
Yep.
Nice. So you can see the difference. So this is what it looked like probably 30 years ago. But in a lot of times, when you go into Google Street View, you can't see the address. The house looks a little different. You can at least look at the image here and get an idea. Oh, okay, that's the house. Because you see the house next door, or the house to the right, and you get, oh, that's the house there. They just must have put new siding on it, and so on and so forth. And then the other thing you want to use on this site is the map. So if you click on the map, and you get to see a lot of different things, okay? You get to see the approximate boundary lines. And I say approximate because these aren't exact, but they're pretty close. And you get to see if there's any off-street parking in the back. See, this is the alley back here.
Okay.
And I'm looking, okay, does it have off-street parking? In this case, since it's my house, I know if it does or it doesn't. In this case, if you use the Google Street View, let's do that now and see if we can get back there. Because there is and there isn't. I say that because it's very tight back there, and it would be really hard to get a car in and out. And unfortunately, see, it won't let me go back that alleyway, but I'll show you the alley. And this is where using both tools will help. See, this is the alley right here, how you get back there.
Yep.
And there potentially is off-street parking. You have to do some excavating back there to make it a little wider turn and so on and so forth. But I look at things like parking, that's important. It's not as important on some streets as it on others. Like for example, this street here, off-street parking is kind of important because if you go down this street here, now you can park only on one side and this street ends. So you're gonna kind of have to turn around down here. So it's not the best street. And you're like, well, why would you buy there? Well, because I bought it for $15,000.
Right.
So the way where this is located, the street, the parking, is there off-street parking, the area, the crime rate, what I know about the neighborhood dictates what I'm going to pay. And how do you learn that? It's just, you're just going to have to just do what I do, which is start watching the market, start using Zillow. At least Zillow is somewhat like an MLS. Like I have the MLS at my access, so at my fingertips, so I can look at all the recent sales, and it's very accurate, and I get a little more information than what Zillow can provide. But the internet's getting really good, and it's getting more and more accurate. So you're gonna have to get really good at using those tools. Now, that's a huge task for you to learn all of Pittsburgh. So the other thing you need to work on, and I guess I can help you with this, is I would narrow it down. You know, you want to narrow it down, one, by price. So whatever your price is, if I can't spend more than 200, okay, you let me know that, and we will eliminate 80%. Let's say we eliminate half the neighborhoods, so at least we can chunk it down to something smaller.
Yep.
Then, you know, what's your appetite for D areas and C areas? Oh, you know what? I don't want any bad areas. Okay, so 200K, we want to keep it below that. We don't want any like bad neighborhoods. We don't want any high crime areas. So we can whittle it down to even smaller. So once we whittle it down to it, maybe 4 or 5 or 6 or maybe 10 little communities, it makes your task of learning those neighborhoods that much easier. When you're trying to learn all of Allegheny County, which is enormous, it's going to be a task you'll never get there. I don't even know all of Allegheny County. I don't buy in all of Allegheny County, and if I do, I usually know somebody that I'll partner with, or I'll know somebody who knows the neighborhood before I make any offers. You know, because I'm. So I hope.
Yeah, and for me, Pittsburgh wasn't just like a random city that I picked. You know, my wife is from Natrona Heights, which is up north of the city.
Okay.
So we do have family out there, and so I do have a little bit of intel from my in-law side that, you know, really can help support like what neighborhoods I should be looking at. But you mentioned, you know, neighborhoods would be based on, you know, what I'm willing to spend, and it really comes down to the strategy we're looking to employ. You know, in Bethlehem, we have enough capital to do a buy and hold, but for me, where I'm having trouble seeing how to get to the next step after that is, you know, how do I go buy and hold in Bethlehem and get to the next property? Whereas if I go into Pittsburgh, I probably have a little bit more money to do a rehab and then refinance to an ARV, and then can use that money for the next property. So that's kind of what we're weighing right now.
Is Bethlehem, comparing sale prices, is it a lot more expensive than Pittsburgh in your opinion?
Yes.
Okay. Well, we see that a lot. So I see, I mean, I get investors from literally all over the globe that come here. Not just me. They are coming here than they have for the past 10 or 15 years, because of course, like Bethlehem's expensive. Just think about San Francisco and Silicon Valley, and I mean, even overseas, houses are so expensive. You can't buy anything without $100,000 down, and even if it doesn't cash flow. So it's just like, I'm going to type 100 grand for something that doesn't even make me any money. So that's why the competition is harder here too, because of that. Your second question was, when you work with investors, what value are you looking for them to provide to your business? No one asked me that question. So
Glad I'm the first.
it's usually, what can you do for me? So what value can you bring? I think it's just listening, just not taking everything I say as gospel, but at least listening, digesting it. Don't talk, listen and digest it, and then come up with your own answer. And a lot of investors, I can just tell, like, they're not listening. I'm talking, but they're just not listening. I just feel like I'm wasting my time. So use my knowledge, use all the mistakes I've made, which is a boatload, and use all of the successes I've had, and I'm relatively successful. I feel I've done a pretty good job after 30 years. I'm in good shape right now, but make a lot of mistakes. I'm not the best investor. I'm not the guy, for sure. I'm not the guy. But what can you do to provide a better experience for me? Just listen and know that I just want to know that you're taking my advice, and I'm adding value to you.
Okay. Now I know you have a property management company. You're a realtor. I think on your property management website you had kind of preferred general contractor too. As you're working with people, are you bringing them into your network? Is that something that you're trying to do, or there's skin in the game for both you and the investors that you work with, or are you also just kind of guiding investors that have their own, say, core four and do the property management realtor with their own team?
Yeah, I don't. Of course, I want to build relationships and attract clients so I can sell them properties, and then eventually I can manage them, hopefully, and maybe someday when they want to downsize or trade or just get out of the business, I'm the guy that's going to sell them. So every person I meet is potentially revenue for me.
Mm-hmm.
But I don't mind helping people. I mean, I'm talking to a guy tomorrow that he already has his own agent. I have a property management guy that we just took on, and he has his own agent right now, but his agent's done such a poor job for him, and the agent referred me to manage it. So it's hard for me to say, hey man, you really paid too much for that. You really shouldn't have bought it. I kind of have to keep a tight lip. I don't like to be in that position, but I don't mind helping people, even if I'm not going to make any money, because honestly, I get referrals a lot. Like, so you might have your own agent, but you're like, yeah, I got this guy, but maybe your neighbor wants to buy a house, and you're like, yeah, I know Bob's doing a good job, but he doesn't know what Alex knows. So why don't you call Alex? So that's why I do this. That's why I record these, so I can get some content out there for my YouTube channel. But I'm just all about building relationships and helping people. That's it. I like to help people. It's just like number two. You said, what can I do? What value you're looking for investors? Just let me help you and take my advice. But talk to other people too. Don't just talk to one agent. Don't talk to one advisor. Talk to other people so you can get different points of view.
Yep. Yeah. I mean, for me being new, I mean, what I'm looking for is, obviously I know I'm not going to do it on my own. You got to build a network. So right now, I really appreciate you responding to the Bigger Pockets request. I think this is a step in the right direction with, going out and, seeing who's available to be in my network. And then if the relationship is authentic and there's something there, I think the business is just going to manifest, and, that network is going to pay dividends, and that, you might do property management or realtor, or, just your expertise would be invaluable. But for me, it's like you said, I'm just trying to listen, absorb, take in everything, learn from people's mistakes, learn from their successes. You can only read so much online and in books, where now I need some applied practice.
Yeah, and you're not that far either. So I would venture to say you should come out here too. Just get the feel of the streets. Maybe spend a few 3-4 days with your wife. Make it like a mini vacation. You got to find somebody to watch the kids, right?
Yep.
So, but that could be a quasi vacation, and get to know this area a little bit. That would be helpful. All right, number 3, what's the typical rent? This is one I maybe don't understand. What is the typical rent to purchase price ratio in the Pittsburgh market?
So what I mean for that is, obviously the buzz terms or rules are the 1% rule, like your purchase price and rent should be 1%. I know in the Bethlehem market, that pretty much doesn't exist out here. There's really not 1% properties. So I
Yeah.
guess where does that ratio fall in the Pittsburgh market?
Well, shoot, man, I guess that's a decent little rule of thumb. But remember the scenario where we talked about Fredonia, where the taxes are really low. Let's not even talk about assessed values, taxes going up or anything. Let's not talk about that. Let's say this Fredonia house, taxes are $2,000 a year, and I'm going to pay $100,000 for it. That same house in another area, the taxes could be $500 a year, and that completely changes that 1% rule.
Yep.
So, like just like in Bethlehem, the 1% rule. I'm gonna shout out some areas, but the 1% rule doesn't work in Shady Side, doesn't work in Mount Lebanon, doesn't work in Collier Township, doesn't work in any A area. The numbers don't make sense. There's no way you're going to get the 1% rule to work. The 1% rule will work really well in like a D neighborhood, but the D neighborhood brings challenges. For example, first thing this morning, Fredonia Street, I get a call from a detective, 8 o'clock this morning, today. Hey, I need to kick in your door. Can you get down here to open it? I'm like, why? Because your tenant son is a criminal and he's inside. I'm like, okay. So my friend was just here, my worker guy, and he's like, hey, he came back. I said, take the keys to the detective, please. So that's the kind of stuff you deal with. This is a C name. This is C.
Okay.
That's why this property popped up in my head when this is one I was dealing with this morning. That was a great way to start the day. So now I have a busted in door, and the guy barricaded himself in there, and they took him away in handcuffs. And I rented this house to a nice older lady with a 780 credit score. And she moved in, the criminal son, and I think she moved out. So that's the kind of stuff you got to deal with that they don't teach you on Bigger Pockets.
Right.
So that's why that's why the D areas are, and again, this is a C area. I had this property rented since 2015 for 7 years to the same tenant. They were amazing. Amazing. Next tenant, I get this. So that's what I'll try to help you navigate through. That's the challenge when buying property.
Okay.
All right. So we talked about the 1% rule. Number 4 question. I have about 6-7 more minutes, so we'll be good. Are you okay on time?
I'm good, thank you.
Okay. As an investor, what types of properties do you primarily focus on? Buy and hold, BRRRR, flip. Hold. All three, but less flipping now. Flipping has become so hard to find a good deal, and prices of labor and materials have skyrocketed. Every flip I've done in the past couple of years has just been not worth my time. I would have been better off not doing it, But I would focus on knowing what I know about you and why you're doing this. You're going to want to focus on the buy and hold and or the BRRRR. BRRRR is nice because you can force appreciation by doing repairs and getting the rents up and doing like that. But a good buy and hold, there's nothing wrong with that either. That's what I would focus.
So I guess for me with a buy and hold strategy, where I get probably net a little bit of positive cash flow, what would be my next steps? And after I lock in that first property, like what's the path to get to the second one to continue to build my portfolio?
How would you buy? Let's talk about this scenario. How would you buy $150,000 duplex here? How would you purchase it financially? How would you do it?
So I couldn't purchase that outright, so I would put the 25% down. And I have more than that, but I would try to keep as much capital for myself as possible.
Gotcha. So 25% down, that's $30,000 plus closing costs. Let's say 35 grand.
Yep.
Now, how would you buy your next one?
That's where I'd become capital restricted, right?
Okay.
So I could probably actually, if I bought one, spent 35 grand, I could probably buy the same one, roll into two properties, but then moving from two to three would be where I'd run out of funds.
Gotcha. Okay, so the best path of least resistance would probably be, I think you mentioned it, would be like a line of credit on your home.
Mhm.
So let's say you have some cash and you could get a line of credit. But the beauty of that is you could write off the line of credit interest and you can use it to purchase your next property. So we buy that $150,000 duplex. Hopefully we get it for 140. Let's say we get it for 10,000 below market value, which is incredibly good in today's market. We get the rents up, maybe do a little bit of work there, and in 8 months to a year and a half, it appraises for 210. At that point, you refinance, hopefully get all of your money back, rinse and repeat.
Okay.
And then you just keep doing that. You know, it just, you get that's how you do it. I mean, that's the only way to do it. And it takes a long time, but
So even with that, with a buy and hold, I guess maybe what I'm hearing is your suggestion is probably not to buy something completely turnkey though, right? I want to buy something I can add value into, right? So that when I do
yeah,
refinance,
yeah.
I can recoup more through that appreciation.
It can be turnkey, but it just it has to be underperforming.
Okay.
But what the best ones are, the ones that are not turnkey and they're underperforming. You know, those are the best ones.
Okay.
But underperforming, and it's a lot of, there's a lot of them out there. There's a lot of folks that have owned properties for a long time. They're older. They don't want to rock the boat. They don't want to raise their rents. They don't want to do any upgrades like flooring and paint, maybe pop in a quick small kitchen, where I'm happy to do that, you know, because I know what the rent market is, and it's here, but I know it's here. I know what's going to cost me to do that. I know what the property's going to be worth after that. But that doesn't put immediate money in your pocket. It just takes time. You know, that's why doing the first one, it might be a year before you get the second one. Then it might be 8 months before you get the third. Then it might be 6 months before you get the fourth. But then you get a system down, you really get to know your neighborhoods. You can easily buy a couple properties a year, maybe 3 or 4. I mean, you can scale this as big as you want to get. That's the beauty about this, but it's not an easy road and it takes time.
Yep. So if I went the Burr method, walk me through how I should look at that process.
Yeah, I think the way we just talked about would be paying cash,
Yep.
having some money set aside so we can do some minor upgrades, increase the rents, because we want to look at the leases before we make a purchase. We want to check out those leases. Is there a sales clause? Is it a month to month? So then we know how quickly we can get those rents up, and then get the property stabilized, then refinance.
Okay. Yeah. So say we're looking at the same type of property, right? Maybe it needs more work, but after the ARV would be maybe 140, 150,000. So then that would put me in like the 90,000 range. Is that enough? And what neighborhoods does that limit me to? If I'm going to say pay cash and maybe it's a $50,000-$60,000 cash offer, and then I have either $30,000 or $40,000 towards the reno, like is that enough capital for a Burr?
I think so. Yeah.
Yep.
It's not going to be easy. I can just off the top of my head, I know of a duplex right now we were working on getting for around 90,000. It's pretty turnkey. There's 2 1-bedroom units in Cannonsburg, which is just outside of Pittsburgh, and that would have been a good one. What else did we buy recently? There's quite a few. A lot of times we buy them and we get them operating and then we sell them. I'll sell them to my investor clients. We make them and then we move on because we need to keep our engine churning, and that's there's long-term income, which usually sucks up a lot of capital. And then the short-term income is just buying, selling, taking that money, buying something, holding, buy, sell, take that money, buy something, hold it. You know, that's where a lot of investors are. That's why I get the question that you didn't ask me, which I get a lot of times is, well, if you're an agent and you own 190 units and you have a management company, why would you sell it to me? Just because of that. I can't keep everything. And I always leave some meat on the bone. I don't take advantage of my clients. A lot of agents and a lot of investors, they do. They kill the golden goose is what they do.
Okay.
I don't do that. The last question: what consideration should I take as a long distance investor? Consideration should I take? I mean, what should you take into consideration being 5 hours away?
Yep. Yeah, obviously not owning a property in my backyard, there's obviously different ways I have to approach it.
Building your team, number one. Number two is probably equal with building your team and relationships is knowing the market. So you're going to have to just be online constantly, just flooding your brain with maybe we focus in on 5 or 10 areas. This way it's, how do you eat an elephant? One bite at a time. That's what we need to do, one bite at a time. So we can't focus on all of Allegheny County, maybe a smaller area, and then just focus on your price range and get to know those markets really well as you're building relationships, building your team. And at some point, you just got to pull the trigger. But when you do pull the trigger, I would make it a safer investment. Every time I buy something, I look at the scenarios: best case, worst case, and middle of the road. And worst case, if I can live with losing $20,000 and I learn something, then I'm going to pull the trigger. After I've done all my due diligence, if it meets the criteria, best case, worst case, and I can live with the worst case, then I'm going to pull the trigger. So we'll keep you in something safe and low in the lower price range, I think, because you limit your exposure that way.
Okay. Now you mentioned the point about building the team. You know, as a first-time investor with no skin in the game, you know, is that something I do along the way? As you know, obviously you got to have a realtor first, but then you acquire the property and maybe identify property management and contractors at that point. Or do you recommend that, you know, I try to build that team before moving on any property?
Yeah, I wouldn't get caught in paralysis analysis. So that would mean you want to wait till everything's perfect before you pull the trigger. You don't want to do that, but you also don't want to leap before you look. So I think a combination of both. Continue talking to other agents, talking to other property management companies, learning the market, studying it, getting all your finances ready. Like if you're going to do a HELOC on your house, get that ready, get that money ready to go, and doing all this at the same time. And if a deal comes up before you know everything, then you pull the trigger. If you don't pull the trigger, that's fine. But just, you got to immerse yourself in this. But thank you so much. I appreciate it. Stay in touch. You have my email, and go to my YouTube channel and just subscribe. And then eventually this will be up there and you can watch some of the other videos that are specific more to Pittsburgh real estate.
All right, that'd be great. Thank you.
Everybody, have a good day.